Marie-Laure is Deputy CEO of STOA. STOA is the emerging markets infra vehicle of CDC and AFD. If you can make your way on, I'm going to talk while you're finding your seats. She benefits from a huge experience in corporate finance, M&A, project finance. Before STOA, she was a senior executive director at Caisse des Dépôts et Consignations, where she was in charge of transportation, sustainability, sustainable mobility, and environmental sectors. Over to you and your panel. Thank you.
Good afternoon, everybody. I'm very pleased to collaborate and lead this panel, which is composed of different parties coming from different parts of the world. So you have around the table Christopher Brett Hall, who is VP Senior Credit Officer in the Infrastructure Finance Group of Moodys. Also, Akshay Fofaria, who is partner in Pinson Manson. Fabrice Henry, Managing Director and founder of Astris Finance. Eduardo Plepax, Head of Infrastructure Investment in GTIS. Chris Millward, Regional Head of MIGA, in charge of EMEA region. And Dominique Tumfart, Managing Director, Infrastructure and Energy Finance of Deutsche Bank. Welcome you on board. I would like to give some keynotes just to set the scene on developing and financing infrastructure in emerging markets, and just to give some words around the critical access of infrastructure, sustainable and resilient in economic growth is perhaps one of the few core elements of development that all economists can agree upon. Developed and developing countries invest in infrastructure according to their different needs, reducing inequality, meeting the growing needs of the population, and embracing new technology waves, among others. All you know that we, in terms of investment need annually, McKinsey forecast 3.3 trillion of investment required, out of which 50% would be dedicated to power and roads, and 60% account for developing countries. However, the infrastructure is still lacking in these economies, especially the emerging market. I will illustrate those by, for example, the railroad density in Africa, Latin America, East Asia, and Pacific Asia is a bit more than half of European density. The best performing Africa port, excluding South Africa, is under 45% of international best practice standard. You still lack a lot of electricity connection in sub-Saharan Africa, and the gap is still important in the telecom sector, in emerging markets, not in the mobile telephony, which has developed very quickly, but on the internet, which account for less than 50% of the population having access to internet, while North Africa reached 90%, and France is targeting to reach 100% with this numeric plan. So how can we explain that this region, which most critically need to invest in infrastructure, is lag behind the rest of the world? Probably there is, more and more participation from the private sector to invest in this market, and which reached financial close last year for around 92 billion worth of investment. That is some recall from the World Bank, but however, the World Bank noted that Out of it, the highest level of investment went to East Asia and Pacific, including China. Among the 52 countries which have received investment, 58 account of the total went through China, Indonesia, Mexico, Brazil, and Pakistan. Energy and transportation account for the largest target sector with 55% and 40% respectively. 70% of the 2017 investment was bank debt financing, but only 22% financed by commercial bank, and 40% of the deal were awarded through competitive bid or negotiation. So it comes from this figure that the private sector, despite the growing appetite, is still depending on multilateral institution money and the concessional loan to finance infrastructure deal in emerging markets. The key reasons behind this delay negotiation to reach financial close can be risk allocation, who take the risk and why, shortage of credit enhancements, sector stability, currency, macroeconomic or political risk. To respond to that, for example, in the energy sector, the World Bank has coordinated response to this main problem by launching the Scaling Solar initiative in 4 African countries. However, not all can implement a Scaling Solar program, or whatever new DFI stamps mechanism can develop. So I would like to address to the panel the following question, and each from their standpoint, is how can we generally address this key hurdle to develop and finance infrastructure in emerging market and help to fill the gap through either by investing as a direct investor or providing financing from the debt side or the credit enhancement tools. So I will give the floor to Eduardo from GTIS. So to explain to us what kind of initiative he has developed in Brazil, especially in the infrastructure sector.
Yes, thank you. Thank you so much for the invitation. First, I'd like just to mention very quickly about who we are. GTIS is a leading real asset private equity firms in America. We were founded in 2005, and we started the activity doing investment on real estate, and we have a vertically integrated platform. So we manage the structuring, the design, development, and operation of our assets. And during this year, 2018, we started our efforts on infrastructure to pursue investments on renewable, mainly wind and solar, and also in infrastructure technology. So I'd like to mention first about why infrastructure now in countries such as Brazil is the place that I managed from there. First of all, Brazil has a meaningful gap on infrastructure. The country just invests like 2% of the GDP on infrastructure, and this is even lower than the depreciation amount of the assets that currently Brazil has. And this level should be around 4% to increase the quality and to attend the demand. And if we considering the GDP forecast for the country, that is around 1.5% this year and 2.5% next year, we really need to have a higher number of investments in the country in infrastructure, and we should have at least this 4% of investment from comparing to the GDP. And comparing to other countries such US and China, US has around 5% and China 13%. And also, the country approved in the last years new legislations to control public expenditure, and that approval creates a lot of restriction for the government to increase investments, create a lot of limitations for the government to continue spending a lot of money on infrastructure. So the private sector needs to step in, and this is already doing, and this is already happening there. And also the government is doing a lot of reforms, so they are increasing the privatization, concessions, PPPs, and this is something that are creating a very compelling environment for foreign investors like us. And due to the recent economic and political dislocation that happened in the country, some players are out of the market. So this also creates a very good moment for investors. And just to give some facts, some figures, in the next 8 years, we forecast that the renewable sector will add at least 20 gigawatts of wind and 6-7 gigawatts of solar. And this will need around $25 billion of investments. So we don't believe that the current players has all this money to do equity and debt, so new players will be needing the market. And another very important thing, and to be honest, I believe this is one of the main characteristics of Brazil, is we have one of the highest contract returns. It's the returns that you have during your PPA period. It's during the period that you have a long-term contract. In Brazil, mainly, you have 20 years inflation linked. Even when you close a corporate PPA, it's a lower tenor, but it's contracted. So compared to other countries, sometimes it's 4 or 5 times these kind of returns contracted. And this is a global trend of corporate PPAs, but Brazil, it's happened a lot. 30% of all the energy sold in the market are already in this free market, and this is increasing due to companies moving to the corporate PPAs, also the increase on the necessity to ensure that they have energy for long term and with a predictable cost. And just to finalize, I'd like to mention some, I could say lessons learned, but some characteristics of investing in emerging market. It's you need to focus a lot on governance. So sometimes when you go to a country to do investments, you need to face different legislation, different procedures. So when you do investments in a global basis, you need to have your own corporate governance, and this needs to be higher than the country's legislation. So that's a very important thing. So when you're doing the planning, you need to focus always on procedures. You need to focus on training. You need to focus on having the right team and do the risk matrix and the risk assessment, and also the resource studies. So I believe that when you are doing investments in a country such as Brazil, you need to make sure that you take analysis and manage all these aspects that I just mentioned. And when you are executing your project, I think one of the main lessons learned I took is you need to have a contract management system. You need to manage the interfaces. You need to manage different contracts, different parts. For instance, you need to manage the legal, the technical, and the finance departments with a way that you can flow between each department, and you manage your contract in a way that you avoid claims, you avoid problems with your debt. So also, in one lessons learned, I think it's important that some country, and emerging market mainly, you have a health and safety procedures that are not exactly what you expect. So as a company, you need to focus to having that. So that's extremely important. And just to finalize, after the period of execution or construction, you enter in the operational phase. So you need to have, again, to manage your structure, to operate your assets. So one of the main mistakes I see on different countries is many groups believe that the same teams that are managing construction will manage operation. That's not exactly true in all the cases. Sometimes you need to do the assessment of the team, you need to do the assessment of the activities that will be done in the future to make sure that you have the right team. In countries on emerging markets such as Brazil, you may face a problem to have that. So you need to train, you need to prepare even earlier, even before you finalize your construction. And for sure, you need to make sure that you have the right reports when you get in operational phase of the projects. So that's it. That's the
Thank you very much, Eduardo, for your very operational experience and feedback. I will turn the floor to Fabrice Henry. You know Fabrice as financial advisor and as managing director of Astris Finance, who has been in this market for 20 years almost, for advising sponsors and arranging debt financing in emerging market. What do you want to share with us in terms of the lesson learned and what you will focus on in terms of risk, main risk identified for this project?
So I will start by saying that about half of our work is in mature markets, mostly Europe and North America. And about half of our work is in emerging markets, Latin America and Southeast Asia. And all in all, when I look at our projects in emerging markets, I would say that they are much more fun than the ones in developed markets. They are much more complex from a risk perspective. Two reasons for this. First, the number of risks and the intensity of those risks is much greater. So no two solutions are alike. No two problems are alike. And every time you have a project, you need to think of the best way to allocate the risk to the right party. But also, it's rare when you try to raise non-recourse financing for a project in emerging market. It's rare that you can find a funding source willing to take all the risks. So a lot of our work is involved in doing a very detailed analysis of the risk and passing out the risk to the party most able to take it. I'll give you a simple example, which was closed a month ago. What I think is the very first non-recourse project finance transaction for a renewable project in Vietnam. The Vietnamese PPA has a couple of very big gaps to the point that no international banks would touch it. And so we went to the IFC, we went to MIGA, we went to the ADB, and nobody would touch it. So, but renewable energy is really needed in Vietnam. They have this huge gap in the metrics, in the energy metrics. They need to put 30 gigawatt online in the next 15 years, and they can't do it all with coal. So everybody knows that renewable energy needs to be part of the energy metrics. What did we do? We found risk takers in Vietnam that are comfortable with the local risk, with the PPA risk, and we're bringing liquidity from outside of Vietnam. So that kind of risk allocation, I think, is quite interesting. The one risk I'd like to talk briefly about, because it's prevalent in a number of emerging market projects, is currency risk. As we know, infrastructure projects generate benefits that accrue to users, end users that have local currency income. And when you raise dollar financing or euro financing on a local currency income base, it can turn pretty early. Even when the contractual framework actually transfers the risk from the project to the off-taker, in the case of a power plant, for instance, the local utility that buys the energy or the end users that pays for the energy has local currency income, and they will suffer when the currency turns. And I think what we've learned from past crisis, currency crisis, is there is no amount of structuring that can take care of major currency events. I remember the Asian currency crisis in the late 90s, where a number of PPAs, power purchase agreements, in Indonesia had been denominated in dollars, and PLN, the local utility, was left completely unable to comply with its dollar payment obligations and had to default on those PPAs. So what is the solution for currency risk in emerging market? It's a simple solution, pretty drastic. Just get rid of it altogether and seek local financing, local currency financing. I realize it's easier said than done. I realize that some countries are more vulnerable, especially the countries that haven't gone through pension reform, the countries that don't have deep financial markets. And even when you have a somewhat deep financial market, bringing local savings, local institutional money to the infrastructure sector is not an easy deal. I mean, it took 8-10 years for us to achieve this in Europe. You know, it's going to take a long time in certain markets. There is hope, though. I think there's a growing trend of this happening, and I'd like to mention very quickly, if I still have time, Colombia. Colombia has done a terrific job in the last 5-6 years. About 6 years ago, the government of Colombia set out to launch a $20 billion road concession program. And they realized that it would be dangerous for them to finance it entirely in dollars. So the government crafted a contractual framework with a revenue mix for the concessions that has part in dollars and part in local currency, in Colombian peso. And they sized the local currency component of the program to adapt to the growing, initially pretty low, but growing capacity of the local financing system to provide local currency financing. Because really, when you try to do this, when you try to bring local currency financing to an infrastructure sector, it's a bit a chicken and the egg factor. Governments are reluctant to structuring their projects with local currency financing if there is no local currency flows. And on the other side of the equation, investors are reluctant to invest in building a team, in building the capacity for an asset class that doesn't exist yet. The Colombian government was smart. They launched this program. They announced that part of it would need to be funded locally. It sent a pretty strong signal to the market, to market participants, that there would be a steady flow, steady supply of infrastructure paper. So local players set up their teams. They build up capacity. The largest commercial banks set up project finance teams. They recruited from other countries often. Local institutional investors, pension funds teamed up with international asset managers to set up debt funds, infrastructure debt funds. And the result 5 years later is you now have 20 to 25-year local currency financing available in Colombia that will take construction risk and traffic risk. And if some of you have worked on the Colombia road program, you'll tell me it's not a perfect program. It certainly is not perfect, but it's a great step in the right direction, which will leave Colombia stronger the next time a currency crisis hit.
Thank you, Fabrice. Thank you very much. Dominic, turning to the perspective of a commercial debt arranger provider, what can you say in terms of the other key parameter that the private debt provider are considering when investing in emerging market, and who are the commercial debt provider for infrastructure in this market?
Well, a lot of them are sitting here. So let me start by saying it's great to be here in Paris, which is a massively important private debt infrastructure finance market. The French corporate and investment banks are the most formidable competitors to what we do as a provider and arranger of risk capital, be it as debt financiers or as counterparties for foreign exchange, currencies, inflation hedges. And the French institutional investors are an indispensable complementary source of capital in placing debt over the long term as syndication partners. We're talking about emerging markets. I think it's probably topical to just spend a few minutes around the theme of how heterogeneous these emerging markets really are. If you take one metric, which is the MSCI Emerging Markets Index, there are 24 constituents which make up that particular index. When you look at some of the sub-criteria, you see what the massive differences there are. The weighting of China, for example, in the MSCI EM index is 29.92%, followed by South Korea, Taiwan, India, and Brazil. The remaining 19 countries together make up less than China. You look at a huge variation in ratings from double A ratings, I meant to say, to single B ratings. You're talking about a limited, we are in Paris where the OECD is located, we are talking about 8 members out of 24 who are members of the OECD. You're talking about massive currency volatility, as most of you know. This has been in the headlines in the last few weeks. The Argentinian peso lost about 50% against the dollar throughout this year. The Turkish lira lost about 40% against the US dollar this year. And one final criteria, Africa, which is obviously always center of attention here in the Francophone world. Only 2 out of those 24 countries of the MSCI EM index are actually located in Africa, i.e. Egypt and South Africa. Now, if we talk a little bit what the private sector is looking for, the key parameters for infrastructure debt financings in emerging markets are exactly the same as in the developed world, except they're all exacerbated by some other factors. And a lot of these came up this morning already and this afternoon. One is political risk, which includes rule of law, regulatory risk, and transfer risk. And the other one is economic risk, which includes all the much quoted market risks, foreign exchange risks, inflation risks, and interest rate risk. Where do the private sector debt providers fit in. I think, again, a lot of the parameters were mentioned. Clearly, when you talk about international banks that need to finance themselves in the wholesale markets, by comparison to recycling local retail balance sheets, we are bound to operate in hard currencies. That's what Fabrice just spent a lot of time on. But that doesn't mean that we cannot be hugely instrumental in facilitating infrastructure debt financings. What we do are bridge financings, whether they are construction financings, whether they are equity bridge financings. Once these assets are essentially de-risked post-commercial operating date, the ideal long-term source of capital, and I completely agree with Fabrice on that one, are the local currency, long-term orientated investors, the local currency pension funds, the insurance companies, the direct lending funds. There is a reason why a significant percentage of solar projects in South Africa ended up with Old Mutual and other local life insurance companies, for example. Next topic, tenors. I made reference to that. And a lot of that is implied in the discussion that was had earlier in the day around Basel regulation. We, as commercial debt providers, we will increasingly be disincentivized from going long term. So our territory to play in is basically, in terms of tenor, is 5 to 7 years. But that's sufficient oftentimes to de-risk project, to get them from construction to smooth operation, to flesh out early teething issues around infrastructure projects, and de-risk them sufficiently so they are capable of being placed with institutional investors. 3 more criteria which are very important for private sector players. One is the ability to basically benchmark financings against other financial instruments. A lot what we do is probably more so than what the development banks are bound to do is looking at infrastructure debt financings in the context of relative value considerations. Obviously, the ability to benchmark a loan or a private placement or a public bond instrument against the sovereign debt outstanding or corporate debt outstanding or even some infrastructure agencies outstanding is a very important tool in correctly pricing your risk tool. Visibility on your ability to de-risk financings is another one. That means the ability to syndicate to other market participants and not incurring a very illiquid instrument is an important consideration. And finally, pricing brings me back to the topic of relative value. What we have noticed in some markets where there is significant private sector and development finance deal flow, incidentally, some of the Latin American countries, oftentimes the risk premium you do for a deal in those countries do not justify your deployment of risk capital. Take Mexico, take renewable energy financings in Mexico. The incremental yield you're getting oftentimes on a risk-adjusted return doesn't really stack up. I think I want to keep it to that so that other people have.
Thank you very much, Dominique. I will pass the floor to Chris from MEGA. MEGA has been instrumental, I think, in helping and facilitating, project financing in emerging market. Chris, could you talk about a little bit of the initiative that you have taken with other DFIs to mobilize private sector on project financing and the tools and instruments you have developed more recently to facilitate, the leverage?
Thank you. Yes, MEGA is the institution of the World Bank Group that provides political risk insurance and credit enhancement to private sector investors. I wanted to address the infrastructure gap, the financing gap. There's last year there was $140 million worth of donor money, and the financing needs are over $1 trillion. So the gap is very clear. There's also a timing issue. Climate change is making adaptation and mitigation ever more urgent, and technology is creating a huge expectation of aspiration in developing markets. And people who are sitting in the poorer countries can see very clearly how richer countries live. And that's creating a certain expectations that creates an urgency for infrastructure to develop much more quickly. With respect to the financing gap, it's very clear. It's a priority of the G20 to mobilize commercial financing, private sector capital, using concessional finance. The bank group has a response to that, which is actually an internal response, which is to always prioritize commercial financing whenever it is available. If it is not available, why is it not available? Is it due to sector reforms that need to be achieved? Is it because that there are risk issues that can be addressed through risk mitigation instruments? Or if if private sector capital is available, then this should be prioritized over public sector money. And this is a sort of an internal metric that the World Bank is using. And within this, one example of how this has worked has actually been in Egypt, which is the Feed-in Tariff program, FIT2 program, whereby the World Bank provided upstream sector reform support to the Egyptian government. IFC came in with specific advice on the tariff, on the program, and financing. And MIGA has come in on the providing political risk insurance to equity investors. And EBRD is also involved in that program. So this is a very holistic solution of providing both the soft support on sector reform, as well as financial advice, technical advice on the tendering, and also on the financing and risk mitigation. As part of what we call maximizing finance for development, a subset of this is something that we call a private sector window. It's a private sector facility that has been allocated from donor money that is provided to the World Bank every 3 years. So there's $2.5 billion of this private sector facility that is allocated to providing guarantees and credit enhancement instruments to make unbankable deals bankable in the poorest countries of the world. Within MIGA, there's a MIGA guarantee facility, which is we use this donor money to act as a first loss facility that benefits the investor through having cheaper premium rates and increasing capacity. So we've drawn on this facility a couple of times. One example has been in Myanmar, which is the construction of a fiber optic cable, where MIGA is providing political risk insurance to a Chinese lender at terms cheaper and at amounts greater than it would otherwise have been able to have provided, and is therefore helping making that project bankable. Another example has been in Sierra Leone for Orange Africa through its subsidiary, which is we're providing political risk guarantees to Sonatel to increase their investments in Sierra Leone in the telecom sector. So I'll just leave my comments there for now.
Thank you very much, Chris. Christopher, on the Moodys side, who is looking after default and recovery rate on project finance, notwithstanding the challenges and risk associated with emerging market that we have touched base just now, the credit performance of project finance loan in emerging market has been very resilient. And proved that the underlying, business and models has been adequately analyzed, assessed, and allocate among the party. Could you give us your view on this infrastructure market in emerging market?
Sure, thank you. So I'll comment on the performance of project finance generally, and then within an emerging market subset, and then look at some of the innovative structures that we're rating that are using some of these multilateral development bank initiatives. So Moody's every year publishes a project finance default study looking at back to 1983 over 7,000 project finance loans. For the first time in December of last year, we looked at specifically an emerging market subset of that. And I think what's interesting to point out is that the performance of the emerging market subset in project finance infrastructure was perhaps better than you might think. So in terms of default rates, the emerging market subset default rate was about 9 to 9.5%. The advanced economy subset was 5.5 to 6%. Now, the emerging market subset, those default rates are consistent with BA1 on our rating scale, so just one notch below investment grade. The developed economy subset was more consistent with BAA3. But in terms of recovery, so looking at the actual recovery that the banks receive following a default, it was broadly consistent across emerging and developed economy subsets, around 80%, and clearly there'll be variation based on reason for default, country, and sector. But I think, that's a fairly striking result. And if you look at the reasons for default in emerging markets, about half of them really are related to country risk. So in periods of sovereign stress, that's what's driving the default. In the developed economies, it's more related to market risk, price risk, demand risk that are within those structures. So again, that speaks to space and scope for using enhancement products in emerging markets that specifically target country-related risks. And this report, I might just mention, the World Bank published, I think it was in March of this year, credit characteristics of infrastructure, I think considerations for regulators, citing some of the Moody's findings. And their conclusion was that there is scope to reduce capital charge for infrastructure assets in both developed and emerging deals. So now maybe getting to the credit enhancement products themselves, I'd say in the last year or two, we've really seen quite a lot of innovation, flexibility in terms of how these are being applied. And I might point to, let's say, two different tracks of where this is going. So we heard earlier, governments, particularly in Africa, are experiencing limited fiscal headroom, rising debt levels, US interest rate normalization, making the refinancings more expensive. Infrastructure projects take a long time to realize their benefit, that there's not much fiscal space there. But the multilaterals, again, are coming up to limits in particular countries. They have limited balance sheets. How are they going to try to bring in private sector money and also perhaps relieve their own balance sheets? So maybe on the latter, in terms of relieving multilateral but also commercial bank balance sheets, we saw not too long ago the African Development Bank announced a very innovative transaction where they entered into a synthetic securitization of $1 billion portfolio of their loans with Mariner, a fund based in New York, who essentially provided credit insurance for those loans. Moody's also rated earlier this year the first project infrastructure finance CLO, collateralized loan obligation, in the Asia-Pacific region. That was about 37 loans, mostly in Asia-Pacific, some in the Middle East. Over a third of them were in sub-investment grade jurisdictions, so below BAA3 on our rating scale. That was about 450 million. I think most of them in project finance of renewables, power, and commodities. So again, an innovative way in the Asia-Pacific market of banks trying to open up their balance sheet for further lending. So that's on the portfolio side, that's on relieving balance sheets. Then project-specific, don't have time to go into too many details, but we've seen, again, a sort of flexibility in terms of how multilateral support is being used to either wrap entire risks of repayment or pick out targeted risks. So we rated earlier this year a transaction in Ukraine country rating CAA2. This was a project, designed to store spent nuclear waste so the country didn't need to rely on Russia. Perhaps unsurprisingly, the US government was very supportive of the project. OPIC, the development finance institution in the US, provided political risk insurance on the debt obligation of that Ukrainian state utility to pay debt service. So that was covering, debt obligations. We've also seen on the local currency side, as we heard mentioned from Fabrice earlier, Garantco providing local currency guarantees in India to allow a power project developer to refinance dollar debt with rupee-denominated debt. And then finally, Amiga project with the EBRD in Turkey, a PPP project, provided targeted insurance, expropriation, currency convertibility, transferability, and breach of contract, together with an EBRD liquidity facility that was subordinated. And that project now is rated at Baa2, whereas the Turkish sovereign is at Ba3. So again, we've seen examples of tangible support getting a distinct rating benefit depending on the circumstances.
Thank you very much, Chris. So we have touched base on investor experience in project financing, advisor and point of view from financial advisor, debt provider, multilaterals, and rating agency. We have less touch base on attention to the legal structure and what certain investors in the recent past have experienced, either from a taxation point of view or creeping expropriation or abrupt expropriation. Could you tell us a little bit more about the legal risk associated to the project and how we overcome those?
Thank you very much, Mary-Laure, and delighted to be here. My name's Akshay Fafaria. I'm from Pinsent Masons. We're a global law firm with about 3,000 people and a leader in infrastructure. We're present in about 4 continents, and I look after their Africa group. There's been a lot of chat this evening about risk-adjusted returns, and that's very much what we're talking about here. We're looking at a return of capital rather than simply a return on capital, and that's really the role that we play in the infrastructure space. The challenge in emerging markets for foreign investors is that your capital is essentially hostage once it's been deployed. And absent some form of diplomatic protection, I'm not talking about gunboat diplomacy here, the protection is really via enforceable legal channels, or by being effectively a good corporate citizen and immersing yourself into the local market. The maximum leverage you have is right at the inception of the project. Once you've sunk your money, it's gone. So that's the point at which the legal protection, the structural protection is obtained. The challenge, of course, is that in emerging markets, and this is a cliche, the legal infrastructure is generally not 100% adequate. You've got judicial delays, you've got executive and general corruption, sometimes a bit of fiscal uncertainty, and a great deal of breach of contract risk. But obviously that's matched by exceptional opportunity. So what does an investor or a lender do in those circumstances? Well, the first thing you do is you do your homework. You make sure that you've done thorough legal and commercial due diligence to evaluate the risks, and someone spoke about that earlier on. The recent crises in emerging markets have demonstrated the importance of counterparty risk. And I'm not talking about just risk with your joint venture partners, we're talking about risk with government, with contractors, with your supply chain. And if you're in a regulated market like oil and gas or minerals or telecoms, it's pretty acute. In some circumstances, if your partner goes bust, you may lose your license to the great shock of your lenders and others. And you can put in place carefully created ownership retention structures to mitigate some of that. You can't necessarily mitigate corruption risk, and you need to put in place procedures to protect against that. And similarly, no amount of legal structuring is going to assist you where the revenue-generating entity is incapable of servicing its obligations. And we see this with the large state off-takers in countries like Nigeria, where no project on the grid itself is capable of getting off the ground simply because there isn't a bankable institution behind it, unless it goes through some form of World Bank or MEGA wrap. But again, we've, as lawyers advising some of the parties on large-scale power projects in West Africa, have heard echoes and whispers of a desire on the part of government to no longer be on the hook for these very onerous arrangements from their perspective, very optimum arrangements from the perspective of an investor or a lender. They want optionality. They want the ability to breach contracts when they can, or they have to, for political purposes. So one needs to look at it also from their perspective and to see what is ultimately realistic in these markets. Secondly, from a micro perspective, it's obviously important to put in place good contractual protections. And what we've also noticed in emerging markets where the opportunities for generation of cash are very high is that you need to expect instability. These contracts often run for 10, 15, 25 years, and you're likely to see variations, volatility in structural demand. You're likely to see volatility in underlying resource prices. And sometimes it's just as risky to make too much money as it is to make too little money, as we've seen if you're MTN in West Africa, if you're Procter & Gamble in Tanzania, if you are some of the miners in DRC who've had their contracts revisited. And a degree of flex that is installed right on day one into some of these contractual arrangements will pay dividends later if you have a long-term enlightened view of your contract and your positioning in that market. Obviously, where commercially possible, it's always been the advice of international lawyers to ensure that, where possible, internationalize some of your payment and security structures so that you can access security offshore. And I don't mean in sort of offshore islands, but in jurisdictions where you've got decent legal infrastructure. Now, this always has to be done bearing in mind local exchange control concerns, and obviously concerns around breaching some of those domestic regulations where you may actually be penalized in your home country, in the UK or France, due to new regulations which we put in place to stop money laundering, to stop foreign evasion of taxation, to avoid foreign bribery and corruption. So very important to do your analysis. And if you're a contractor or a participant in some of these projects, from a practical perspective, what's very important is to have information. It's not just to have your legal rights, but it's the ability to have an early warning system in place so that if something goes wrong, you know about it. So you have those auditing rights. You are on the board. You have some sort of shareholder participation. And then finally, to avoid some of these issues around judicial delays, etc., you want to maximize self-help, put in place systems where you can step in without having to go through the courts, where you've got powers of attorney in place so that you can be the arbiter of a default. Obviously, your counterparty will be protected through their own dispute resolution provisions, so they hopefully shouldn't be too upset about that. But those are things that you should think about. Thirdly, internationalize. So if you're looking at very large-scale investments in emerging markets, and this will get the lawyers in the room from Paris salivating, make sure you stabilize your contracts. This doesn't mean eliminating all of the regulatory space. There's a new generation of contract negotiators, lawyers in place who recognize that governments need to have sustainability in terms of their own regulatory space. You cannot stop them from legislating. You should not stop them from regulating when it comes to the environment, when it comes to health and safety, when it comes to their own domestic workforce. So very important to have a long-term enlightened view. Where possible, obviously submit to international arbitration to get access to enforceability worldwide. And if you've got a qualifying investment, make sure it's routed through a jurisdiction which benefits from a BIT. Now, BITs have got a very bad name through all of the things that have gone wrong in Argentina. South Africa have decided to cancel a lot of theirs. But there's a new generation of BITs in place which have a statute of limitations, which take care of the government's regulatory space. And then the last two items I wanted to mention were for very, very large projects where you have the ability to work with your own sovereign, sometimes getting them under an MOU wrapper where you've got additional state support is very welcome. It gives you increasingly important diplomatic protection. And finally, and last but not least, make sure you comply with domestic regulations. The fact that these are emerging markets or last frontier nations don't mean that they do not have law. They do. And as a matter of simple respect, as a foreign investor, you should seek to comply with those regulations always, simply because in markets where there's less ability to get those items judicially adjudicated, you're very, very dependent on executive discretion. And if you're non-compliant, you're at the mercy of the state. Do not depend on ministerial contacts. As we know from Brazil, elections happen, the regimes change. So it's incredibly important to ensure that you're compliant.
Thank you very much. Akshay. I think the panel was very, I think, wide and provide a wide range of, views and point of view on how to finance and develop infrastructure in emerging market. I think to conclude on a positive point, I think what has been demonstrated here is that to develop and finance infrastructure in emerging markets, you have to work hard, very hard, conduct in-depth due diligence, being very analytical in a whole aspect, being resilient and patient, and also being creative to enhance the robustness of the structure and the overall creditworthiness of the project, and work with local parties to match, volatility and mitigate also risk. Thank you very much, all of you.
Thank you very much, Marie-Laure, for your excellent